join. There's several others who've told me that they plan to. I'm going to put folks on the spot. I know you guys are muted and don't have video on, but I would love to hear from at least 2 or 3 folks why they're here today or what they're hoping to get out of today's conversation. Who
Uh,
can I
I,
put on
I
the spot?
I would also real quick. I would encourage people to unmute and be talkative during the presentation.
Yeah.
The more feedback, the more questions you guys have, the better. The more we're going to get out of it. And otherwise, it's going to be a really quick presentation of me running through some slides and then we're out of here. So
Yep. Yep.
definitely
Awesome.
feel free to speak up.
Yeah. Awesome. Sandy, I'll put you on the spot since I see your lovely face today. Why are you here? Aside from the fact I might have told you to be here, I don't know. Oh, you're muted.
Okay, I just needed to unmute. I was just going to tap in the chat box. Any type of tax savings for us as realtors? Any types of, things that we can take to our tax person and get some savings on?
Yeah, and we'll kind of talk about some things. A lot of the things that I will talk about today definitely impact real estate investors as much as they impact real estate agents and just business in general. I view it as mainly even the real estate investing side. I kind of look at it as how to operate a business, and that's kind of one of some of the slides we hit today. That's some of the things we'll talk about
Yep.
is managing your business well first and foremost.
Awesome. Let's hear from a couple others. Who else? Sandy did the softball. I'm here to find ways to save money on taxes. Who else wants to chime in? Lauren, I see you unmuted. Are you getting ready to say something? Maybe not. All right. Well, we'll get rolling and
Oh, sorry, I'm logged in under Lauren, and that's my
who
fiance's
is
name. I was wondering why I always see that on there, and I should be logged in under my name. She's on Zoom all the time. I never get on here,
Gotcha. Who
but
is this?
it's Landon.
Oh, Landon. Hey man, how's it going?
Yeah, good.
Good.
Yeah,
What are you hoping to get out of today's conversation?
I'm interested in hearing anything that has to do with real estate investing, tax saving, stuff like that. Just, I don't know a whole lot about it. I usually leave it up to the accountant to figure that stuff out. But if I can, I mean, are these things, some of these things that accountants don't really know, or maybe just less experienced ones and stuff like that, or like what kind of stuff are we? I guess we'll see, right?
Yep. Well, I wanted to tee up this conversation. I'll tee you up, Kyle, and then you run with it. So my brief overview of my story is that I found my way into this industry as an investor. My wife and I, we were broke grad school students, but we were able to scrap together $8,600 to put down to buy a duplex that we lived in one side. And so that was actually almost 10 years ago. And so we've kind of grown from there and built a small investment portfolio. And both real estate sales as well as real estate investing, as Kyle mentioned earlier, those are both businesses. The IRS sees them as businesses. And when you have a business, there's a lot of different things you can do from a tax optimization standpoint. Many of us look at taxes as like yawn, boring, I gotta pay them, but I'm not interested in them. But the more that we really seek to be savvy business owners, the more we realize that tax optimization is one of the levers that we use in order to build wealth. And I got connected to Kyle because another one of our agents, Tracy Jones, who said she'd be on if she wasn't on her way to a listing appointment, basically shared, "Hey, I'm doing this thing with Kyle that's saving me a lot of money," and it was a strategy that I had heard about but never really pursued. So Kyle and I have worked together. His team has put together some reports that are going to save me north of $40,000 in taxes this year, which is a pretty cool thing. I think it was $47,000 is what it netted out to. And so Kyle is with Midwest Property Advisors. He does a number of different things, but as a CPA and a real estate focused, investment focused CPA, I think we've got a lot to learn from him. So with that, Kyle, I know you teach regularly. You don't need me to hold your hand, so I'll let you take the floor.
No, I appreciate the introduction. Do this class quite a bit, but today's a little different in that I don't typically do it online. Typically, I'm live, and so I'm up and moving around and walking and using my hands to talk and stuff. So having to be in a chair facing a camera today is a little different. So I apologize up front if I struggle. Um, for the folks that just came in, do want to say feel free to interrupt, ask questions. Don't think you got to sit on mute the entire time and not say anything. Want it to be as interactive as possible. Now, just a little more of an introduction there. Again, my name's Kyle Turner. Really operate two businesses in the real estate world. I'm a partner with Revere Carr and Monroe. I'll show you that here in a minute on the slide deck. We're a full service accounting firm here in Wichita. My client base here is probably 75% real estate related in some fashion. A lot of that is real estate investors as well as real estate agents. Also work with a lot of contractors, plumbers, electricians, what have you, that are involved in the real estate world as well. So a lot of our clientele is connected to real estate in some form or fashion. The other business, as Mark mentioned, is Midwest Property Advisors. That one's completely real estate focused there. We do cost segregation out of that business, and then we offer what I would call investor friendly bookkeeping. So it's more of an economic bookkeeping and not what you would get with your full service accounting firm. So something that is able to grow with you guys as you grow as investors or as business people in general along those lines. My background, spent about 15 years in large multinational companies, but before venturing out on my own into this little adventure. Was head of tax and accounting departments for very, very large multinational companies. Have a law degree and an accounting degree. So also, like Mark, was a broke grad student not very long ago. Paid a lot for that education, but it's been worth it. That's what I keep telling my kids. I tell my kids that writing that check for those student loans every month is my favorite bill to pay because it's been the most profitable for me. So today's presentation, we'll hit a few things. We'll talk about business entity structures and kind of what they look like and how you talk about them in the legal world and how you talk about them with your tax professional. I know that can get confusing for some folks. We'll hit some general accounting stuff and just how you should keep your books, why you should keep your books, those types of things. We'll talk general tax as well, around what's deductible, what's not, what's income, what's not. Those types of things, and then as well as hit some tax strategies at the end that are mainly real estate investor friendly. But I will say, you guys as agents have the perfect set of facts to go be a real estate investor and use that to really impact your tax position and help reduce your tax liability.
And just to jump in really quick, Kyle, on that note, as I see who's in the room so far, I know many of you are either investor curious, or at least open to it. And then some of you may say, like, I'm just an agent and I'm looking to save money on my taxes as an agent. You should be thinking as a wealth builder one way or the other, which doesn't mean you have to buy an apartment complex to do that. But I want to caution you against binary thinking where it's like, oh, that's for them. We have unfair advantages as those with licenses because we have access and more information than a lot of people do. And so to fail to think as a wealth building, investment minded person is missing out on a major opportunity, in my humble opinion. So whether you buy a duplex this year or not is less aside, but I don't want you to turning off your investor brain simply if you don't, identify as one who's looking to invest. So be open to every aspect of what Kyle's about to share with us.
Yeah, and I guess one of the questions I would have is kind of who is everybody here real estate your full-time thing? I would assume everybody's a full-time agent. Yeah. So you guys really have a great set of facts, especially if you've got a spouse that works and earns W-2 type income. You've got a great set of facts to even limit the tax on that income. So really taking the tax burden off your spouse's income by leveraging your real estate professional status, which under the tax law we're going to talk about in a little bit, but which is a thing under the tax law that you guys certainly have because of your day job. And so From a real estate tax person, it's the perfect set of facts. You guys are the ideal clients, and have the ideal opportunity to limit your taxability. All right, I'm going to attempt to share my screen here. It gets a little wonky sometimes with our cloud setup here and the 25 monitors I use, but we'll make it work.
I feel like
I
you
don't know,
just
Mark,
like
did you
accountant.
share this presentation with everybody or?
Oh, I no, I didn't.
Okay.
I assumed you would, and we can
And
roll.
that's fine. After it's over, if anybody wants a copy of it or whatever,
Yeah,
just let me
I'll
or Mark
email it
Warren
out to the
know,
folks that are
and
here for sure.
we can get it to everybody for sure.
I was just going to say, I felt like
Let's
you used an
see.
accountant pickup line with us that we have the perfect set of facts. Well, thank you, Kyle. I don't know why I'm blushing right now. Perfect.
You guys got my presentation? Is that what we're seeing?
Yes, sir.
Perfect. Yeah. Probably moved screens on me, didn't it? You guys got the slide deck, or are you seeing just the PowerPoint itself?
We're seeing the PowerPoint in.
Yeah,
You're not in yet present mode.
Hold on.
I think if you click present from beginning in the top of your
Yeah,
PowerPoint.
it sticks it over in a different screen.
Oh, sure. I'm a one monitor man. I'm simple.
Sometimes I wish I was. Let me get this. Okay. Let me get back. Sorry, guys. Like I said, just bear with me.
You're doing fine.
There we go. How's that look?
That works.
Does it work?
It's
Does it
in
work?
it's in kind of like portrait mode.
It's too small, and I
Yeah.
don't know why it won't show it on one of my other
I think
monitors.
it'll work though. We're big kids. And I'll email it to everybody after the fact. So the main thing is listen to Kyle. I'll email
Uh,
this out as a
the
PDF.
issue, guys, is I've got one monitor that is um, upright for reading
Oh,
documents on, and for whatever reason, PowerPoint wants to throw it onto that monitor, and I can't get it to
you're fine.
act
Let's
for
roll.
me. All right, yeah, we won't waste any more of you guys' time. Okay, so what I like to start with is legal entity structure, and a lot of this is a lot of how tax works with your legal entity and how to communicate to your CPA about your legal entity, right? So for most of us, we're probably in some sort of LLC. So you've got an LLC set up at your in your local jurisdiction. That LLC is a legal concept and not really a tax concept. The tax structure of your legal entity is really going to depend on the owners of the LLC and some elections that you make around the LLC. So there's really three major types of tax entities that we talk about around LLCs. One's being a single member LLC. So that's when there's only one owner. So if you set up an LLC and you're the only owner of it, you're a single member LLC from a tax perspective. And that means within the tax world, that entity doesn't really exist. It only exists for legal purposes. So it's a disregarded entity from a tax standpoint, which means it doesn't pay any tax. It doesn't have a tax filing. It's going to be Schedule C on your 1040 return or potentially Schedule E, depending on what you're doing. So for you guys, your real estate agent business, it's going to be Schedule C on your tax return, where income and expenses are going to be calculated at. The next step of that is a multi-member LLC. So where we see this a lot on the real estate side is real estate investing. It's a husband and wife. They both own 50/50 of the LLC. So it's a multi-member LLC. And from a tax perspective, this is a partnership. So it's not labeled an LLC in the tax world. Again, it's a completely different vehicle in the tax world. It's a partnership. Because it's a partnership, it files a Form 1065, but it doesn't pay any tax. All of that income coming off of that multi-member LLC still flows to your individual tax return. You'll get a K1, much like a W-2 from that partnership. And then that K1, the information on it goes onto your individual return. and that's where the tax is collected. So from a tax perspective, that's what we refer to as a flow-through entity. So the single member is a disregarded entity. The partnership is a flow-through entity. Now, to complicate that just a little more, any of these LLCs, you can make what's called an S Corp election on. So it gets you corporate treatment from a tax perspective, but not in the form of like a traditional C corporation that you think of, a large corporation. The S Corp is not a typical vehicle that we would use for real estate investors, but it is something that I would want to see for you guys as real estate agents. If you're a real estate agent operating with a single member LLC, you really should be considering making an S Corp election on that. A couple things happen when you make that S Corp election. You do have to pay yourself from that S Corp. So you have to generate payroll for yourself and give yourself a pay, whether that's monthly, biweekly, it can be whatever. The S Corp is still a flow-through entity, so it doesn't pay any tax. It files a tax return. It files the 1120S, but again, no tax on it. You still get a K-1 from it. The K-1 provides you information that goes on your tax return, and that's how the income coming out of it's taxed. Where the S Corp makes the most sense for you guys and what the benefit it is right now, if you've got a single member LLC that's a Schedule C on your tax return, if you have $300,000 of income for the year, you're paying payroll tax on that entire $300,000. So think of it as it's self-employment tax is what you're paying, but think of it as payroll tax, like I said, right? Mm-hmm. So that's 7.5% that normally gets withheld out of your W-2. You're paying on that full amount to the maximums. So you're maxing it out, paying as much self-employment tax as you can possibly pay. And that's over and above income tax, which is typically a big surprise to a lot of self-employed folks. A lot of self-employed folks you're looking at, you make $100,000 a year, you're calculating your taxes during the year, and you're thinking, okay, I want to owe 15% of that this year, so I've got 15,000 that I've held back to pay taxes, and then you do your tax return, and suddenly you owe 22 or 23,000 in tax. Well, that's because you owed another $7,000 in self-employment tax on top of the income tax. And what the S Corp does is allows us to manage that number more, that self-employment tax number, because income flowing through the S Corp does not attract self-employment tax, only the piece that you set yourself up for payroll on. Mm-hmm. So again, if you've got an entity, you're going to net $100,000 or so a year. Our recommendation would probably be to set yourself up with a payroll to yourself of about 60 grand or so a year. And then that way we'd take that 40,000 a year and avoid self-employment tax on it. And those numbers, as your commission base grows, as your business grows, those numbers get bigger and bigger because we're going to keep your payroll number as low as we can. And as your non-payroll number gets larger and larger, the tax savings get larger and larger. So this is a great vehicle that I don't normally spend a lot of time on because because of how property flows in and out of an S Corp, we don't typically recommend this for our real estate investors. The only reason I even have it on the slide deck is a lot of times my investor groups will end up operating property management firms. That's typically the way investors go, right? You start with a few properties that you're paying somebody else to manage, and then before you know it, you've got so many properties that it makes more sense to start your own property management firm and pay somebody to manage your properties and somebody else's and then make money off of those. So you end up basically managing yours for free, right? Those are the type of things that we would structure in this S Corp. But for you guys, if you're not in an S Corp structure, I would highly recommend that you talk to your tax advisor about it as to whether or not it can be beneficial for you guys, because most times it really will be.
We just got a couple questions that I think you kind of just answered, but just to clarify, Sandy has asked, basically clarifying, as realtors, we should use an LLC, right?
Yeah, absolutely. You should.
And not so much because it's automatic tax savings, Sandy, but because it gives you the ability to not pay that self-employment tax. So you're paying more tax by not having an LLC, bottom line. Carly then asked Kyle, if basically, is there an income threshold where an S Corp typically makes sense?
Yeah, there are. Both of those are really great questions. Back on the LLC for a moment, I would recommend anytime you're operating any kind of business, you have it inside an LLC. And that is twofold. It does give you flexibility around potential tax savings. So we always we'll have those options, and to just the legal protection of it as well. That way, should the worst of the worst happen, and for some reason you're being sued, it's the LLC that's being sued and not you personally being sued. Now, we'll caution that having that LLC is not an automatic barrier to liability. The other thing I always recommend to people is make sure you talk to your insurance provider. That's who's going to be your biggest barrier to liability. So you want to make sure you're in good shape there. Um, from an S corp perspective, I would typically tell people that you want to be in that probably above that 150,000 a year in net income range a year before it really makes sense to do, because there are some additional costs to it. You're going to have a tax filing, and you're going to have payroll that you're going to have to pay somebody to process for, or learn to do yourself, both of which have a cost, right? Our times is valuable sometimes as our money. So I typically tell clients we want to be in that situation when we get to about 150,000 or so in net income a year and above. And then as I said, once you continue to grow, that savings just continues to grow as well. So it's definitely a worthwhile structure, especially for you guys on the agent side of things.
Thank you.
Good questions. Good questions. Accounting. This is the section where I tend to beat my clients up the most, to be honest with you. I rail on people about having good books and keeping their books current, and understanding how their investments are performing, right? What I see so much in small business, especially, and with my real estate investing clients, is that they don't keep accurate books. They basically rely on the checking account to be their books. And if the checking account went up this month, we must have done all right, right? Not keeping P&L on the business, not updating it, on a monthly basis or something, and understanding how the business is performing. That is really important, especially if your business has multiple layers to it. So if you're doing you're running your real estate agent business and you're doing wholesaling on top of that, or you're doing flips on top of that, we want to make sure that we're understanding how each of those business lines are doing and how each are producing revenue independent of one another, so that we can make good business decisions on whether or not we want to continue down one of those paths. We want to focus more on one of those paths. Where this really comes into play for investors is making sure you're doing you're tracking income by property, income and expenses by property, so that the house on the east side of town is making really good money. The house on the west side of town is just not making money. So it makes sense for me to sell that property and go buy another property on the east side of town. That way you understand how those assets are performing, and you know whether or not you need to get rid of certain assets or you need to spend more on certain assets. For you guys, where it's going to be really important is understanding from an agent perspective on like what advertising methods are working. Is Facebook advertising working? Is networking with friends working? And understanding where those expenses are going and the income that's coming off of them. So a big thing for me and with all of my clients is making sure you have a good set of books. You're understanding how those books work, and you're updating them, at least on a monthly basis, so that you have a good idea of your business. We'll usually talk about it on the next slide, but really the other place that books come in really important, especially for you guys that are investors, is when you go to the bank for that next loan. They're going to ask to see your income statement. They're going to ask to see your balance sheet and things like that. And if you've got those prepared and you can show them, hey, look, here's the last investments we made. We're making solid money on them. They're doing well as investments. That gives them more confidence in you, allows them to be able to loan more to you, and allows you to keep building the portfolio that you have. Resources on the accounting side, so things that are out there that you can use. Software packages like QuickBooks. If you're at a certain level as far as complexity goes, I strongly recommend QuickBooks. You'll hear me say later, I hate QuickBooks. We have a very love-hate relationship. I hate it, but it's honestly the best product out there, so I love it to death at the same time. With the online version of it, it'll connect to your bank accounts. So transactions import in, and then all you're really doing is sort of tagging those transactions on what type of expense they were, and or income and what type of income it was and things like that. So it makes it super easy. You don't have to know accounting. That it has a feature where you can give your tax advisor or your accountant access to it, to where they can get information from it without having to bother you for that information. They can come in and help you with it with things like that. So great program. Highly recommend it. A couple free programs that are out there. Stessa is geared toward real estate investors. It does a pretty phenomenal job for investors that have, a handful of properties, 5, maybe 10 properties. But once you get above that, it starts to lose its ability to work well for folks. And then we kind of start pointing toward QuickBooks. Waveapps.com is a program I absolutely love. It's basically a free version of QuickBooks. Now, not quite as sophisticated as QuickBooks, maybe a little more difficult to use. There's some quirks about it that you kind of learn. But again, it is free, so you kind of get what you pay for, right? But I love it. We operate a couple of our businesses off of it. Just makes things really easy. Again, connects to your bank account, so transactions come in. You can see your bank account inside the program and all those types of things. Then obviously third parties. Plug myself here. Regier Carr Monroe, again, full service accounting. We do payroll. We do audits. We do tax return prep. We do tax planning. We do everything you can think of here. So lean on your CPA, your tax advisor, if you're needing help with your books. I'm sure they've got a service they provide, or they've got somebody that they would recommend. If they don't, give me a call. We'll be happy to do it for you. And then Midwest Property Advisors. Again, we're starting a small bookkeeping arm over there that's really investor focused. So dealing with real estate investors and those that are not looking to go spend $140 an hour on an accounting firm. We've got more economical options to help you get started in your investing life and help you grow. And then once you outgrow us, we'll be happy to pass you on to somebody that's a little more full service. So definitely look out there in those options. I encourage people to outsource their bookkeeping at some point, just because it's time you're going to have to spend to do it, when you could be spending time doing what it is you're good at, right? Rather than spending those 3 hours trying to figure out your books, you can pay somebody $100 to do it, and you can go spend those 3 hours selling homes or buying homes or whatever your method is. I think it comes back to that thing of when we got to know when to fire ourselves, right? And make sure we're paying folks to do it, which is why I've quit doing home improvement projects myself, right? It makes more sense to pay somebody to do it than it does spend my time on it. So
good word.
All right. Questions around that before we move on? Again, guys, don't be afraid to speak up. I appreciate the interruption. So coming out of the books and doing the accounting, why you need those good books are these financial metrics that we all look at as part of our businesses, right? If we're looking at cash flow and return on investment, some of these are dedicated to real estate investors, right? If we're looking at cap rates, we're looking at rent multipliers or debt service coverage ratios, which is the topic du jour lately. It seems everybody's doing these DSCR loans now. These are all terms that you need to know and analytics that you need to look at as part of your business, but we can't look at those and we can't analyze those without having good books. So it all comes back to being successful in your business is really having your books under control, knowing where your income is coming from, knowing where your expenses are going, and being able to pull those levers within your business to maximize those. One story I typically tell here, I've got a client, it's non-real estate related, actually. They operate retail stores here in Kansas. It's on hearing aids, believe it or not. For a number of years, they had 5 retail stores, and they were making a couple $100,000 a year, doing great. That flipping that off like a coupon basically every year, 200 grand a year for the last 10 years or so. They came on as clients, new clients. We kind of dug into their books, and I was like, hey, do we have books by store, or is it just the one set of books? And it's like, oh, we've always just done it as one set. Everything flows into this one QuickBooks. And I was like, okay, that's great. Let's go spend some time and do it by store. And so we dug in and done their books by store. And when we did that, what we found out was they had 3 stores that were losing close to $150,000 a year a piece. Mm-hmm. So just by analyzing it on that level, we went in and they basically closed those 3 stores, and the next year they made over $500,000. And
Wow.
they could have been doing that all along just by closing down those stores. But because they didn't have those books at a asset level, if you will, and a store level, they didn't know. They were basically, again, relying on the checking account went up this month, so we must have done good business wise. And that's why it's very important that you guys are on top of your books. Now we'll kind of jump into the tax world a little bit here and just talk about the types of income that there are within tax, and then we'll talk about deductions after that. Within the tax world, there's really 2 main buckets of income, and that's non-passive and passive income. So your non-passive income is going to be your W-2 income, your business income, so your real estate agent income, flips and short-term rentals all fall into that. The downfall of your non-passive income, this is the income that attracts self-employment and payroll taxes, right, that we talked about earlier. The other bucket is passive income. So this is your rental income, cap gains, portfolio type income. There's no self-employment income or payroll taxes here. The thing that we do from a tax planning point of view, we either try to, typically we're creating a huge tax loss with our rental income, and I'll show you how we do that later with our rental business. And we want to be able to flip that over to non-passive income in order to offset the income that's being earned on the business income side of things. Or again, typically it's another spouse that has a large W-2 job or something like that. So we want to offset that income as well. So those are the things that we typically do strategy wise. We want to blend these 2 types of income together. Without strategy, if you're just filing your income tax return, heads up, just the way it is, these types of incomes they don't go together. So if I've got a loss on the passive side and income on the non-passive side, I'm going to pay tax on that income on the non-passive side, even though my loss may be larger than that on my passive side. So we want to find ways to make that passive income non-passive in order to offset that taxable income. Again, you guys are the perfect set of facts for this because you're already real estate professionals. So that means that any type of rental income or loss that you guys have is considered non-passive. You guys are the unicorn in the tax world in that you get this special treatment of that rental income being non-passive income.
Kyle, I'm a dense person, so I just want to reiterate or like reflect back what I think you just said to us, for my sake, but also in case others just missed it.
Yeah.
If I'm understanding correctly, you were saying, okay, there's 2 types of income. There's active and passive. Active is susceptible or exposed to different types of taxes, but it's also you're able to take deductions in the active world that you can't take in the passive world, right?
Well, you're not able to use your non-passive losses. So typically what
Right.
we do with real estate, when you think about real estate, you want real estate that investments that cash flow for you, right? So your rental properties are cash flowing. In the real world, you're making money on them. In the tax world, we're going to use tax strategies like accelerated depreciation, cost segregation, those type of things to create a tax loss on them. And so typically what happens is now we've got this huge tax loss on this non-passive side, and we've got a lot of income on the passive side. We've got a lot of income on the non-passive active side. And since I'm not able to use that non-passive loss to offset that active income, I just end up with this loss that I'm carrying forward for years on my real estate, which is not typically a bad thing, but we're not getting the immediate impact out of it.
And
Where
when you
you guys are special is now I can create that tax loss on that real estate investment and use it to offset your real estate agent income and reduce your overall tax burden.
because
Or
sorry, I'm interrupting, but
no,
our
go ahead.
because our perfect set of facts, to use your language, is that we are, according to the IRS, real estate professionals, not just
Yeah,
because we have a license, but because what is it? We give 1,000 hours a year to.
it's 750 hours a year. I've got a slide on it here in a minute, and we'll get
Okay,
to it.
sorry, I'm getting ahead of
But
myself.
but
But
yeah, no, you're
all that
fine.
to
You're fine.
say, like, if we were doctors or if we were corporate people, who didn't have that professional status, we wouldn't be able to do what you're describing, correct?
Yeah, that's right. That's right. There's other hoops we'd have to jump through to get you guys there. Um, where this can really be beneficial, it's for real estate agents that have a spouse that's a high wage earner on the W-2 side. We can typically we can take a real estate agent and buy a few properties in a year and virtually eliminate a spouse's income tax on a high wage earner. So to your example, Mark, if that spouse is the doctor or lawyer or CEO or something like that, and you're the real estate agent, we can use your set of facts to really reduce the overall tax burden for the both of you.
That's awesome. Thank you.
So deductions. Okay, we talked about income. Now let's talk about deductions a little bit. Get a lot of questions around deductions all the time. That's what people all want to know. What can I deduct? What can I deduct? Anything business related is a deductible expense. So if it's 100% related to your business, you're able to deduct it regardless of what it is. Now there may be some far-flung examples out there that doesn't actually hold true to, but for 99.9% of things, if it's related to your business, you're going to be able to deduct it. And we'll jump into a couple of the specific examples here in a minute. But then the other big expense you have around businesses and especially real estate investing is depreciation. So things that garner depreciation are your capital assets. So the structure of the building you buy, major components, HVAC, roofs, things like that. Inside those capital assets, they all have class lives under the tax law. Those are 5-year, 15-year, and 27.5-year are typically what we deal with real estate, with real estate investors. 5-year stuff, thinking of stuff that typically will last 5 years. Appliances, flooring, things that fall into this that you wouldn't think would, or like kitchen cabinets, kitchen countertops, things like that. 15-year life stuff is site improvements, so grading work that's done on the site, driveways, sidewalks, retaining walls, fences, and then landscaping as well. So the sod that goes in, trees, flowers, those types of things. Your 27.5-year property is your building structure and typically major building components as well. So think of the walls and roof of the building and foundation and those types of things. The big question we run into around these types of assets is repair versus maintenance, and that's expense versus depreciation. So basically, are we repairing something and that's an expense that we're going to write off directly this year, or are we replacing something and that's an expense that's going to have to be depreciated? The classic tax example here is the roof. So if you've got a roof on a building and you go and you reshingle that roof, if you're just putting shingles on the building, it's going to be considered a repair and you're going to be able to expense that cost in the current tax year. But if you go down to the decking of the roof and you replace the decking and the shingles, it's considered a replacement of that roof. And so now you're going to depreciate it over 27.5 years. So whether or not something's a repair or a replacement and whether we get an expense or depreciation on it will often, you're going to often get the answer you don't want, and that's it depends. So there's going to be more information that's going to be required to understand what those are.
And if I'm understanding correctly, Kyle, an expense is going to be more immediately beneficial from a tax
Yes,
standpoint.
absolutely.
I can just take that as a loss, right?
That's something we're going to take as a deduction in your current tax year whenever that expense occurs, rather than taking a small piece of the expense over many years, which is what depreciation does.
Understood.
Vehicles, this is a big one that I have a lot of conversations with real estate agents around mileage versus actual expenses and whether or not your LLC should own the vehicle. My advice would be is if you've got a vehicle that's 100% business, typically having the LLC own it and taking depreciation on the vehicle is a good play from a tax perspective. Then that way you're writing off gas, you're writing off oil changes, you're writing off tires, writing off all the maintenance on it. You just have to be careful you don't want much personal use out of it. Now, if you tell me it's 100% business, but I occasionally stop and get groceries on the way home, that's great. Not worried about that at all. If you're saying it's my business car, but I run the kids to practice in it, and we take family vacations in it, and it's starting to look more like your personal car, then there's more work that we've got to do there and around determining what that real split between personal and work is. And then there'll be some personal use of it that becomes taxable to you. Basically, if there was $100 of expense on the car and it was a 60-40 split, basically what would happen is we'd take that $100 deduction, but then you'd have $40 of income that you had to show on your return So you really only get to a net of 60% deduction on it. The other option on the vehicle, which is what most people do, is taking the mileage expense. Um, right now, with where the mileage rate is, I've got 65.5 on here, but I think it's up another penny or so now here for 24. So if you're getting 65 cents or so a mile and you've got a car that gets pretty decent gas mileage, you're really recouping that cost of gas pretty quick. Um, and also, if you're a person like me that tends to hang on to a vehicle for a long time, taking the mileage can typically, over the life of the vehicle, lead to more deduction than taking the cost of the vehicle and depreciating it. Um, I know for me personally, I've got a $40,000 car I drive, but it's got 225,000 miles on it. So at 65 cents a mile, I've done a whole lot better than the $40,000 that the vehicle cost. So those are all things you're going to want to think about. It kind of depends on your conversation with your tax advisor and what your income looks like in any given year. Because there may be years where, you just happen to need a new car that year, and it's also been a good year, so it makes sense to buy one and through the business and use the depreciation to hold off tax on that year if you don't foresee future years being as good as the current year, things like that. Again, those are conversations you should be having with your tax advisor, multiple times during the year to make sure you're getting the most benefit out of which deductions you have. Mills for 2023 and later years, mills are back down to 50%. I don't know if you were aware or not, but from 20 to 22, we were taking 100% of mills as a deduction. That was a COVID era law change to try to help restaurants and things get back on their feet. So that's back down to 50% now. I see a lot of, Sandy, you'd asked earlier kind of what we should be thinking about as far as deductions for you guys. This is one I see a lot of agents miss, just because they, if you're out showing houses and stop for lunch, then that's a business meal. If you're taking clients to dinner, that's a business meal. If you're out showing houses and take clients to lunch, that's a business meal. If you're providing lunch for clients, that's a business meal. That's one of the things that I think a lot of people will lose sight of, just because it's easy enough. We go to lunch every day, so it's just a normal habit thing, right? To make sure we're doing that. And mileage is the other one. Jump back to it real quick. I there's no good way to track mileage, and if anybody's found a good way, I'd love to hear it. I've got clients that use 25 different apps and some that are still using the logbook in their car and things like that. There just doesn't seem to be a good way to really track it. But that is something to make sure you're tracking in some form or fashion to get a good idea of how close your mileage is.
Anybody want to chime in with their favorite method? Ginger, what do you use?
QuickBooks. It's amazing.
Yeah, I've got a few clients that use QuickBooks and a few that don't like using it. And I don't know what their hang up is on it, but I know some people are not real happy with it either. I tell people all the time that if you really want to make a fortune in this business, is to come up with an app that's easy to use and does a good job tracking mileage and that everybody likes, because that seems to be the thing we're missing out there the most. But as real estate agents, there's a lot of mileage available to you guys, right? You're on the road all the time, so that's one not to skimp on for sure.
Mm-hmm.
Other deductible stuff. Again, some of this is geared toward your real estate investments. Management fees. So if you're paying another company to manage things, utilities on property, interest paid on loans. Again, not the principal that's deductible. It's just the interest. Principal does hurt your cash flow, but it's not deductible. The other big one's insurance and property tax. Those are two of the big ones on investment style properties. Okay, now we'll jump into some of the tax strategies around stuff that we do. Again, this one we've kind of been talking about the whole time, the real estate professional status. Typically, one of the big strategies for my clients is helping them achieve this and get to that real estate professional status. Again, this is easy for you guys. You're already there. You're real estate professionals. But the technical ways to qualify, excuse me, you must perform at least 750 service hours a year in the real estate trade or business. So that sounds really easy to do. 15 hours a week, right? Not a big deal. Where a lot of people that are not real estate agents full time Struggle on this one is that more than half of all your service hours for the year have to be in the real estate property trade or business. So that means if I'm a school teacher, if I'm an accountant, if I'm something like that, and I'm working 2,500 hours a year at my normal job, to be qualified as a real estate professional, I've got to spend 2,501 hours in the real estate business a year. So that
Mm.
becomes really hard to obtain when you have a full-time W-2 job. Again, so
Even
you
if
guys are
even if you're licensed, like this doesn't care if you have your license or not. It's more about the amount of time spent
that's right.
on real
It
estate
has
related
nothing to
activity.
do with the license. It has time about everything as on the time spent.
Mm.
And that time spent can be looking at properties. It can be looking for properties, dealing with tenants, dealing with trades in the business. Getting your plumber out there, those types of things. Um, Dealing with your management company, anything that really involves the real estate business, education in the real estate, meeting with other agents or advisors or investors or what have you.
But if
Uh,
if I have a W-2 job that's not real estate related, it needs to be at least half of my working time.
that's right. Yep. Yep.
Okay.
And that's a tough barrier to overcome for folks that are not in the business the way you guys are.
Yep.
The handful of folks that we can see do it is sometimes teachers and sometimes firefighters, um, just because their schedule allows for it with the amount of off time that they have. Um, but it's a hard hurdle to overcome. But if we overcome it, it's a huge path to savings on tax because again, as we just talked about earlier, it lets you treat that passive income as non-passive, or typically it's passive losses that we're trying to get treated as non-passive. And so that's a huge opportunity for folks on the real estate side. Other tax strategies, again, these are sort of real estate investor focused, but certainly I think it's an opportunity for you guys to take it to your clients and be able to help them find ways to buy more properties. 1031 exchanges. So basically what this is, you're exchanging a property you currently own for a property you want to buy and not pay tax on the capital gain you have on the property that you currently own. It doesn't eliminate the tax; it defers the tax. So if I sell property A and buy property B, I'm not going to pay any tax on the gain I have in property A, but that gain is going to follow over to property B. So when I go to sell property B, I'll pay the full amount of tax then, unless I do another 1031. Uh, I've got several clients that their goal is to 1031 until they die, and then their kids will get a step up in basis on that last property, and so they've managed to avoid tax altogether on any of that gain. Um, I think that's a very optimistic view of how this is going to work because I think there's going to come a time at some point later in life, whether it's when you're 70, 80, or 90 years old, that you're going to need some money out of those properties and you end up selling one and to cover medical expenses or something, and you end up paying all the tax on it.
Mm-hmm.
So I'm not a huge fan of that strategy of 1031 for life. There is opportunities when 1031s make sense to defer that gain and help you go from a C property to a B property or from a B property to an A property, those types of things. When you go down that 1031 path, there are timing rules that you have to respect and meet, and those can be difficult. If once you've sold your property, you've got 45 days to identify the replacement property, so the next property you want to buy, and then 180 days to close on that property. And that 180 days starts when you sell your property, not when you identify the next one. So you really got 45 days to find your property and 180 days to close on your property. The other couple key things on 1031s where some people where typically mistakes are made is you can't take any of the funds out of that and get the full deferral. So even if that's paying down debt. So I'll have clients a lot of times come in and will say, hey, I did a $200,000 1031 exchange. I paid off $100,000 of debt and bought a $100,000 property, so I don't owe any tax, right? Well, because you paid off that $100,000 of debt, that's considered taking cash into your pocket because it changed your financial position. You didn't just get another asset with it. And so now probably only half of that capital gain is going to be deferred. I've seen clients in situations where they've gone through 1031s and used the proceeds to pay down debt and buy a new house without any debt, and they're super happy that they've got a property now and no debt on it, but they used so much to pay down the debt, they ended up owing tax on all their gain on that last property.
Yeah.
And so now they're stuck in a pretty tough position from a tax perspective. So 1031, great vehicle to defer tax. There's some rules around it, some technicalities around it. What I encourage everybody to do is if you're going to do a 1031, get your tax advisor involved early, and so that they're helping you with it. For me personally, I've got a model that I can run for my clients and tell them here's what you need to go buy to completely avoid the gain. Here's how much debt you can pay down, what it's going to cost you to do so, those types of things. If you work with your tax advisor early on, it's going to save you money down the line for sure. Cost segregation. So this is the last thing we talk about, and this is the.
Can I interrupt? We got a couple other questions,
Kyle. Yeah, sure.
Preston asked if there's anything he would need to do in order to obtain the real estate professional designation. Does that require effort, or is that simply your?
No. You guys, it's basically a box you check on the within the tax return on Schedule E in your tax return. You'll be labeled as such, and then there's a statement you'll file with the tax return if you've got multiple properties that you want to treat all the properties as one, so you're getting the real estate investment professional or real estate professional on all of those. But you guys are in a situation again where your tax advisor should already be treating you as such if you're doing investment outside of just your agent work. Again, if they're not, it may be something you want to bring up to them or ask them about. Not all CPAs, tax advisors, are as savvy in the real estate side on some of this stuff as some of us are that do it almost exclusively. So definitely worth a conversation with your tax advisor.
Next question for you here, Kyle. Michelle asks, is there a maximum number of properties that make sense to 1031 before paying the tax?
Gosh, that's a great question. You're going to hate the answer, but the answer is it depends. It's really going to depend on your situation. I usually am of the opinion that we have other options other than the 1031 to reduce the tax that gives you a little more freedom, and we're going to talk about one of these. The other issue with the 1031, unless you're really committed to that, doing it until you die and you get to step up for your kids, is there's a high likelihood that later on the tax rate's going to be higher. We typically take the approach when we're planning for stuff that not that tax rates are going to come down in the future, but tax rates are going to go up in the future. So that's always a worry of mine, right? Is that, yeah, we avoided a $10,000 tax this year, but we get 10 years down the road and we sell a property and trigger all that gain, and then it ended up costing us $12,000. So with inflation the way it is now, that may be $20,000 in the future, right? So it's going to depend on your unique situation. It's going to depend on what else you're doing. What do you plan to do with that cash after you sell the property? If you're rolling it over into another property or just taking cash and moving on and doing something different. It's a great question. I wish I had a better answer for you. It's really just going to be dependent on your situation. That's something we run into a lot in tax, right? Is so many times the answer is going to be it depends. Because it's going to depend on your whole situation and what the future looks like for you and what opportunities you see coming and those types of things. But great question. Wish I had a better answer for you. The other big tax strategy we talk about with everybody is cost segregation. And I don't know how familiar everybody is here with that, but it is a huge opportunity in the real estate world. What cost segregation does is allow you to accelerate depreciation on parts of your investment properties. So the way to think about is typically you go out, you buy an investment property, right? You go out, you buy a $100,000 house. You're going to depreciate that $100,000 house over the next 27 and a half years. So you're taking about $3,000 of depreciation a year. No, it's a little more than that, but just math's hard, right? I need my calculator to get the exact number, but you're taking. Well, I've got it on here. Hey, how about that? $3,600 of depreciation a year, right? Is all you're getting out of that. With cost segregation, we take that $100,000 and we place a dollar value on each piece of that house. So values allocated to the flooring, values allocated to the kitchen cabinets, to the kitchen countertops, to the appliances, to the roof, to the sidewalks, to the grass, to the driveway, to the windows, every bit of those pieces of property that make up that house, right? And then what that allows us to do is all of these things that fit into this 5-year bucket. So, we talked about depreciation earlier and having the different class lives. So everything that fits into that 5-year bucket, which is flooring, removable flooring. So vinyl, carpet, uh, anything that's not affixed to the building. So the things that are excluded are typically tile and hardwood that's nailed down. Every other type of flooring we view as removable goes into that 5-year bucket. Kitchen cabinets going into the 5-year bucket. Appliances, kitchen countertops, specialty plumbing and wiring. So like plumbing to the washing machine, plumbing to the ice maker on the fridge, wiring for computers, computer networks, TVs, things like that, go into that 5-year bucket. Oddly enough, and this one cracks me up, so I always share with everybody. Kitchen cabinets are 5-year life. Bathroom cabinets are 27.5-year life. I don't know about you guys, but on most properties, you replace a bathroom cabinet long before you do kitchen cabinets. Because I
Right.
see
That's
properties
funny.
all the time with kitchen cabinets that are 100 years old in them. So
Yeah.
it's an odd deal. That's the IRS and the federal government for you. That's how they operate. 15-year life again is site improvements. So grading work that's done on the site, even if it's an existing site, dollars get allocated to that. We do cost segregations on houses that are 120 years old at this point, and we allocate some to the site work that was done all those years ago.
Hmm.
And sidewalks, fencing, driveways, and then the landscaping. So the yard, trees, shrubs that are there, those types of things. And then your 27.5-year life is everything that's left over. So that's the roof, the walls, the doors, all of that type of stuff. So what we do with cost segregation, once we've got all these things in their buckets, we're able now to depreciate that flooring and stuff over 5 years. We're able to depreciate all the landscaping and stuff over 15 years. And typically with a $100,000 house, that 5-year life stuff will be about $15,000, and the 15-year life stuff will be about $15,000. So what we've done typically is taken $30,000 and taken it out of that 27.5-year life and put it in a very much smaller life, so that we're taking a bigger deduction in each of those years. Now, right now, this is even better because we have something that's called bonus depreciation. So for those 5 and 15-year lives, rather than depreciating them over that 5 or 15 years, we're able to take for 24, we're able to take 60% of that value in year one. Now, you go back to 23, we were taking 80%, and 22, we were taking 100%. And 22 was a fabulous year because of that 100%, right? I do think we'll get back to 100% and maybe even get 100% for 23, and certainly before 24 is over. And so what that means, if we're at 100%, and let's use 100% as an example, just because it makes the math a little easier to understand, that $30,000 that we are able to allocate to 5-year and 15-year life from a cost segregation standpoint is now immediately deductible in year one. So I don't know what the market's like there, but you go buy $100,000 house here, you're going to have about $1,000 a month in rent on it. Kind of rule of thumb, right? So maybe $12,000 in income that year, and that's just rent. That's before taxes and insurance and all the repairs that we're going to do. And we've got a $30,000 depreciation deduction. We're going to lose at least $18,000 from a tax standpoint that year on that. Again, that's not dollars out of your pocket. That's the tax loss, not the real life loss. Could even be profitable in real life, but you're still going to have an $18,000 tax loss. And that $18,000 tax loss, with your real estate professional status, you can use that to lower your real estate agent income by $18,000. Or if you're not a real estate agent, but you're just a full-time real estate investor, and you've got a spouse that has W-2 income, you can lower that W-2 income by that $18,000. It also works for folks that are neither, right? If you're a real estate investor on the side and you've got a W-2 job, so you're not a real estate professional, we typically use this strategy to lock in that deduction early and create a loss carry forward for them. So now they've got $18,000 of loss that they're carrying forward. So that means that even with no other expenses for the next year and a half, they're not paying any income tax on their rental income. So it makes your investment more or less tax free over that period. Um, Typically, what we see when you add in other expenses, taxes, insurance, interest, those types of things on it, you're going to get about 5 years of income coming off that you're not paying any tax on. And so that really changes the ROI on some properties because you can look at it and say, okay, I'm getting this investment tax free. Normally, you'd look at it and say, hey, it's a 10% investment return. With by the time I add in my tax savings, I may be at 12%. So it's also a tool that we encourage people to use when you're looking at a property, right? You go out and you look at a property and cash flow on it's pretty close to zero, break even. You're thinking may not be worth my time, but we look at the cost segregation and the tax benefits on it, and you add that money into it. If it's saving you, $6,000 of tax this year at a break even cash flow. Now I'm adding that $6,000 to my cash flow. I'm at $500 a month of cash flow. So I encourage people to look at things on an after tax basis. The other mistake we make a lot of times as business owners, we don't account for tax, and that's our biggest expense. Like I said earlier, you look at it and you're thinking, man, I made $100,000 this year. Well, that's before tax. You add in your tax, and you really only made about 75 grand this year. So we need to think about things on an after tax basis because tax, unfortunately, tends to be our biggest expense for a lot of businesses. Questions around cost segment or the slide in general? I think that's yeah. It looks like I got that slide in here twice on this one.
There you go.
I do have a random question.
Yeah.
So, like when you do cost segregation and depreciation, like say that tax year, what happens the following tax year?
Yeah, so the following tax year, like in that example where you're getting $3,600 a year in depreciation, after we take that big bump in the first year, for the next 26 years, you're going to have depreciation of 2,500 or so a year, rather than the 3,600. The other way to think about it is the time value of money opportunity. You're taking a deduction that's 27, 26, 25, 24, 20 years out in the future, and you're taking a part of that deduction and taking it today rather than waiting those 20 some years to take it.
Okay, makes sense.
Yeah. When you think about it that way, it makes a lot of sense in today's environment, especially with inflation where it's at and stuff. You're able to take a deduction at today's dollar values rather than the dollar values that are 20 years down the road.
So Kyle, can you talk with us? I'm gonna go. Why don't you do stop share screen so we can see each other
Yeah,
more?
sorry.
Can you talk with us about sticky wickets, shall we call them, with regards to cost seg and accelerated depreciation? What do we need to be careful of? Who's it for and who's it not for with regards to investors?
Yeah, it's really for long-term investments, right? Doesn't work on flip properties. If you know you're going to sell that property in the next year or two, I wouldn't recommend it because again, we are just accelerating depreciation. So it's reducing your basis. And so there's going to be a larger basis recapture when you do go to sell it eventually.
So translation for the rest of us, if you buy a property, rental property, or one of your clients does, you fully depreciate it, or you take all the depreciation year one, you sell it 2 years later, you're going to get hammered with a tax bill, right?
Yeah.
I mean, or unless you figure
if you don't
else.
go buy something else, if you go buy something else, we can help you avoid it.
Yes.
Again, I look at cost segregation as a big alternative to 1031s because typically if you're selling an investment property, most of the time you're buying the next investment property, right? And so rather than doing a 1031, we'll take and you go buy that next property, we'll do the cost seg on it and generate all that depreciation and soak up the capital gain you had on the initial property anyway. And typically sometimes we get a little bit better answer than you get around the 1031. And you definitely have more flexibility because if we're doing it through that methodology, you can sell your property in January and buy the next one in December, and we're still going to be able to avoid all the gain.
Right.
It gives us a little more flexibility.
Can you talk with us about a lot of agents set aside X% of each commission in order to pay their taxes, whether quarterly or annually. Tell me why we shouldn't do that and why we should consider cost seg as an alternative strategy.
Well, it's just a better return on your money, right? Typically, what I would recommend to folks is if you're setting aside 15% to pay taxes with, or 20% or whatever it is, if you take that 15 or 20% and use it as a down payment on an investment property, we can use cost segregation to basically eliminate your tax, or fairly reduce your tax depending on how much you spend on a property. And rather than giving that dollar to the government, you're giving that dollar to yourself in the form of an asset. So if you think about it from a balance sheet perspective, right? Your balance sheet doesn't change if you use that money and go buy a property. You just moved it from cash into a house. Where if you're paying tax with it, you're taking cash out off your balance sheet and it's going on the government's balance sheet. So you're kind of losing that asset, if you
I mean,
will.
that is like, I don't want to like force everyone to do this, but like, guys, this is an incredibly powerful tool. And I think it's just a foregone conclusion. Yeah, I set aside a percentage of my income for taxes. And it's like, what if I could show you a way where you don't have to do that, and instead you could buy a house that grows in value and pays you over time?
Yeah.
Like it's
Yeah.
that's literally what we're talking about here. And I think so many people, oh, I would buy a rental property if I had the funds. And like Kyle just gave you the funds to do that, is effectively what this does.
Yeah, that's kind of the short version of it, that I would say to people, is that you can give your money to the federal government and state governments, or you can use your money as a down payment on a property. Either one's going to cost you about the same amount, but one's an asset to you and one's an expense to you.
Mm-hmm. I feel like
Hopefully,
that's
an income producing asset is what you end up with.
right. Yeah, yeah. Don't buy crap with it. But I feel like that's the closest thing to a no-brainer in the real estate professional investor
Yeah,
world that I've
yeah.
come across.
And again, you guys have the perfect scenario for it. You guys have the best set of facts imaginable for it.
How would that look though if we pay quarterly? I need to talk with my tax advisor and say, hey, I'm not paying my quarterly
Yeah,
taxes.
yeah, absolutely, absolutely. If you get to the end of the year and you don't owe tax, there's no penalty for not paying your quarterlies, which would be your goal. The other option is if you want to keep paying those quarterlies in to sort of protect yourself, and you go buy a property, and you do the cost segregation on it, you get a large refund at the end of the year. Um, I have a lot of clients in that situation where, again, the spouse is a W-2 earner, so there's taxes being withheld out of the W-2 each paycheck. They bought 15 properties during the year. We do cost segregation on all those, and their tax bill is substantially less now because of that. And then they get a large refund, and that just goes to fuel the investments for that year. But certainly, if you're buying, we for my clients that are in a buying mode and are self-employed, we will reduce what they're paying in estimated taxes quarterly to account for that. And typically what we'll do is meet each quarter and see how much they bought and understand how that impacts their tax from a cost segregation perspective, and make adjustments based on that.
Yeah, I view this as it's not just oh, I did this one time, but Kyle, when we were talking weeks ago, I kind of gave you the like, tell me if I'm misunderstanding this, but savvy people buy a house a year, depreciate it, rinse and repeat. Like
Yeah.
they get the
Yeah,
benefit of
it's
that.
very much a rinse and repeat strategy. It's something you're going to want to keep doing.
10 years from now, at minimum, I bought 10 properties that I fully depreciated, and I didn't have to set aside
Yeah.
taxes for other
Yeah.
things as a result. Like it's a game changer.
And it makes a huge difference right now with bonus depreciation. But even when that bonus goes away, you're talking about a lot of value that gets to a 5-year property. So you're talking about a 5-year return rather than a 1-year return, which, a huge difference between 1 year and 5 years. But most investments, the return's nowhere near that 5 years. You're
No
talking
question.
15, 20 years out. So to be able to get it in 5 years, it's still a pretty good play. And a lot of that just comes down to how much you want to spend, right? We do that with clients as well, where we're comfortable paying X amount of dollars for whatever reason. And so how much do we need to buy this year to pay X amount of dollars, or to be in X tax bracket, or what have you?
If someone does a bonus or accelerated depreciation, but doesn't need the full benefit in that next tax time, can you roll that into the
Yeah,
following year?
absolutely. Absolutely. We carry the loss over to the following year. A lot of clients in that situation that are, heavy real estate investors that are buying hundreds of doors a year, when they're in that active buying mode, like the last couple of years, we would have created millions of dollars of depreciation deductions in those years. And so they've got millions of dollars of losses that they're carrying forward this year in a year in which they're not buying much. And so their investments are returning money for them this year, right? They've got 1,500 doors that are really making money. And so now we're just carrying that loss forward, and it'll cover this year until the market goes back to where they want to be in a buying position.
Mm-hmm. Yeah. So you did work for me that's going to save me $47,000. I'm not going to have a $47,000 tax bill this year. So I effectively have 2, maybe even 3 years that are impacted
Yep.
by the
Yep.
benefit of doing the study one time.
Yeah, absolutely. Absolutely.
It's crazy. Anything else for Kyle? We're a little bit over on time, so I don't want to overdo it. Any other questions?
Oh, I'm good. I'm good. I'm good. I'm good. If anybody has any questions.
I've got one more.
Carly.
Every year when I go to my darn tax guy, I feel like I try to get him to tell me, what are other agents deducting that I'm not doing? Or what do you see in theirs that is twice the amount of mine?
Yeah.
And he always says, I can't tell you, everything looks pretty good. And I'm like, I know there's something I'm missing. Marketing. He always just kind of says marketing and advertising is where I see a lot of agents really get the most deductions. Thoughts on that?
It's difficult to answer without seeing your return, right? But what we do so many of those types of returns. Like I said, it's hundreds of real estate agent returns a year that we do in those types and real estate investor returns that we do. So we're very familiar with what should be being deducted and where the biggest deductions should be. So for a lot of folks, I don't necessarily say, hey, Ginger was deducting this, so you should be deducting this. But I can go back and say, hey, I don't see this deduction on your return. Why is that? Are you not accounting for that? Or are you not? Or a lot of times it's mileage. So, I'll have an agent that comes in and they'll give me 5,000 miles. And I'm like, I know you drove this last month. Why is this so small? And the response typically is, well, I didn't do a good job tracking it. So that's just what I put down. Well, let's figure out a little bit closer to what it should be than that, right? We all know it's more than that. So it's things like that. Again, not a great answer. I apologize for that, but without seeing your actual return and kind of having a little more information, it's hard to answer. Who else?
So I did have a question. So if we were getting into purchasing an investment property, should we create a separate LLC outside of, so I have my business LLC, should I create a separate LLC to purchase the investment property under, or should it be?
Yeah, absolutely. I would. The way I tell people to think about it, I'm not a huge guy of you need an LLC for each property. You'll hear some folks tell you that. Why
nobody got time for that.
Yeah, why they're telling you that is because they make money on each of those LLCs, so they want you to have as many of them as possible. They'll justify it with saying it protects liability reasons and things like that. But one of my biggest clients, they've got a couple thousand doors, and they've got those couple thousand doors in 3 LLCs, and he's an attorney, and so if he's fine with the liability risk on it, then I'm fine with it, right? He would typically tell you that the way to think about it is not having a LLC per property, but think of what the maximum dollar amount is you want per LLC. Now, kind of reverting back to your question on whether you should have a separate LLC for your investment property versus your agent business, absolutely. What I tell people is think about it as revenue streams. So if I've got my agent business revenue stream, I want one LLC. I want my investment properties in another LLC. If I was going to go do flips, I'd want those in a different LLC, even away from my investment properties. The reason for that is it just makes it a little cleaner as far as you, because you are operating 3 very distinct and separate businesses. So you want to treat those businesses differently and have that sort of delineation between them.
Thank you.
Yeah, sure.
What else?
I have a quick question.
when we're making deductions, how do we like draw the line of how much do we deduct without hurting our lendability?
Yeah, so that's a huge question for folks in the real estate side, right? Uh, being self-employed myself, I deal with this all the time too, on a personal basis. So it's really tough. There is some advantage to paying a little tax each year, right? Um, the That's another advantage that the cost segregation and the accelerated depreciation kind of gives you, because you do create a large loss there. You reduce your income quite a bit, but because it all shows up as depreciation on your tax return, most banks, especially if you're dealing with a savvy bank, they'll add that depreciation back to your cash flow because it's not an actual cash expense. And so that's a big benefit to a lot of investors as well.
And Preston, I
But
would
yeah,
just go
but
ahead,
yeah,
Kyle.
that's a good point in that, if you really work to get your income to zero, it can hurt your ability to buy properties and buy a house for yourself. As far as that goes, I've got a kid now that bought a ton of investment properties last year, and he didn't pay any tax on his income because we didn't show any income, and now he can't buy a house. So
Yeah.
we're working
Preston,
through that.
I would just encourage, I think sometimes we think of having an accountant as the person who helps me prepare my taxes, but a good accountant is someone that you're doing tax planning with, not just making sure that you're getting deductions at the end of the year. And so that's a conversation mid-year to say, what needle do I need to thread? How much income do I need to show next year to kind of find that sweet spot? You shouldn't be winging it with TurboTax if you're looking to get into the kind of get seriously into this game.
Yeah, I just hired a CPA to go over quarterly with my stuff. So this whole new year is going to be nice.
Good. Kyle, Michelle asked, kind of relative to setting up an LLC for investing, is it harder to obtain financing if you have an LLC instead of financing personally?
Typically, it's not, because as the LLC is young and before it's earning money, the banks are going to ask you to personally guarantee the loan anyway. So it's really going to come back to your personal credit anyway,
Right.
until the LLC is seasoned and has quite a few investments in it and those types of things.
You're typically going to pay a half point or a point more, maybe just as an investor.
Yeah,
Not
as an
necessarily
investor,
because
yeah,
it's an
that's right. Yeah,
LLC, but because it's a different type of
yeah,
property to
yeah.
you.
Different type of
Um,
loan. Yeah.
yeah. Anything else? Cool. Well, I will email out. Actually, I dropped it in the chat earlier, so I did the work for you. Take it from the chat. If you scroll up, I dropped the PDF in there, for you to pull. Kyle's info's in there, so if there's anything he said that you are curious about, or if there's a tax pro that you need to be in a relationship with, he's clearly he knows what he's doing and is geared towards what we're doing.
Yeah, guys, my contacts in there. My cell phone's in there. Everybody else in my industry gives me a hard time because I give my cell phone out, but that's how I do business. So it's just easier. If you want to shoot me a text or something like that, feel free to, or give me a call. Something I know every time you do something like this, you're gonna go home tonight and go, shoot, I wish I'd asked this. Feel free to shoot that message over, or shoot me an email, shoot me a text, give me a call, whatever. Happy to answer whatever I can for you guys.
Appreciate your time, Kyle. Thanks all for being here and committing to your growth. Enjoy
Thanks,
the rest of the
everybody.
week. Yep. See y'all.